Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the share disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. If I'm sorry. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only, concerning Market Chameleon tools and products. With that, one last look at this disclaimer, and let's welcome Dimitri Porgamonic to the show. How are you doing, D? You there?
Yeah, can you hear me?
Yeah, I got you.
Okay.
All right.
All right. I shared my screen. Can you see
Let
that?
me add it. Yep. There you go.
Okay. Good morning, everyone. Um, in today's session, what we'll do is cover option delta, the option Greek, and discuss quickly, what that means, and how a trader can use the option delta to hedge or mitigate their position risk. And I think a good way to talk about it is look at some examples. So we'll navigate to a option chain here, and let's use Google for example. So I'm going to type in the Google symbol up top in the search box, press enter. This will take us to the Google's main page. Then on the left hand side, we have this menu. Let's click on options and then option chain. I'm going to click on this menu to minimize it and expand our screen. And now we have an option chain here to look at. And here we see right now we're defaulted to the nearest term option expiration. We have the calls on the left hand side, puts on the right hand side, and next to the calls, you see this last column says delta. So if you see here, I could drop it down and change it. It's defaulted to delta. And here we have these different numbers on the left hand side. You'll see that the deltas are positive. On the right hand side, the deltas are negative, which represents that it's looking at it from the side that if you bought, let's say you bought in a call option, well, you have a positive delta, meaning that the call is expected to increase as the stock increases. And so it's moving the same direction. And if the stock decreases, the call price will decrease. On the put, it's the opposite. So if you own a put, the stock goes up, the option value will go down. If the stock goes down, the option value will go up, right? It moves in the opposite direction of the stock. So the value of the option here on the call moves in the same direction as the stock. The put moves in the opposite directions. That's why you have positive and negative. So then we got this number here, and you can see here 54, 34. So what does that mean? And when we look at options, there we have this option pricing model. And the option pricing model, it's amazing model because it does several things. One, it helps us try to put a value on the option based on our assumptions. We could put in assumptions in there where we think interest rates will be this, we think implied volatility will be that, dividends and all this stuff we could put into the option pricing model and come up with a theoretical value. Well, the option pricing model also lets us work backwards and say, well, based on what the option price is, create an implied volatility, and then create these Greeks for me. And delta is one of the Greeks. And what it does is the delta Greek, it tells us how sensitive is this particular option for a $1 move in stock price. Okay, so what we're doing is saying, okay, well, if the stock price is 177.94 and this particular option, let's go to a call, is 47 cents, 49 cents. So let's just say we're going to pick the midpoint, 48 cents. And what the delta is telling us is that if nothing changes as far as implied volatility, time decay, interest rates, if nothing changes except the stock goes up $1, then this option, which is, let's say, 48 cents, is expected to increase by 18 cents. Okay, so if we go up $1 and the option doesn't experience any decay, right? Because it's if you wait a day, 2 days, this option will decay. But if right now, the stock goes up $1 and the implied volatility stays the same as it is now, then this option will increase by 18 cents. If the stock goes down by $1, then this option is expected to decrease by 18 cents. Okay, so we're going from, let's say, 48 cents to 30 cents. Okay, if it goes down $1. And what this will do is now allows us to understand the sensitivity of our option value based on the next dollar move in the stock. And the idea there is that once the stock moves up or down $1, then everything resets and you have a new risk, right? Then at that point, you're going to have a new delta. It could be a new implied volatility. There could be time decay. It'll recalculate and tell you your new delta. So it's telling us our risk sensitivities at this moment. All right, that's what it's telling us. Once things change, markets are dynamic. All your Greeks, all your parameters will start changing as well. So it's like a quick assessment of what is my immediate risk in my portfolio. And you got to imagine we're a option portfolio from professional management, risk management. You're constantly looking at the shifting parameters and managing those. Okay, so there's when we talk about risk management, we're not talking about putting in stop loss orders and shooting out things. We're talking about actually evaluating your risk at the moment and doing hedges before you incur any kind of potential losses. So so that's telling us the risk sensitivity of that option. And of course, all these deltas here are telling us the risk sensitivities of those options. On the opposite side here, just so when you see the put, let's say the 177.5 put, it's giving us a delta of negative 46 over here. So, sorry, negative 46 right here. Well, what this means is if the stock goes down $1, well, that's good for us because then this option will move in the opposite direction, right? The option will go up as the stock goes down. So it will gain 46 cents. That's expected to gain 46 cents with all the other factors staying the same, right? Implied volatility, time decay, everything else staying the same. If the stock goes up $1, well, this option is going in the opposite directions. We have a negative delta, so it's going to lose 46 cents. So that's our risk sensitivity to a dollar move in the option in the stock price. But the delta is also important because now it lets us hedge our risk or mitigate our risk. And keep in mind that when we look at deltas and Greeks and these aren't, these are based on calculations in the option pricing model that have estimates. So there's no perfect hedge. There's just hedges that mitigate your risk. It reduces your, right? So if I do nothing, right? Let's say if I do nothing, then I have total, like to this call, if I do nothing, then I have a risk that if the stock goes down, this will lose value. If it goes up, it gains value. But if I hedge some of that risk, I mitigate some of that directional risk. And why would I want to mitigate my directional risk? Well, as an options trader, I may not be looking at an option from the perspective of direction. Maybe I don't have any directional bias, so I have no way of really calculating an edge directional. I think it could go either way, but the option on a relative basis may look cheap to me based on its implied volatility, right? So if the implied volatility here, let's say, looks cheap or expensive, right? If it looks cheap, I may want to buy it. If it looks expensive, I may want to sell it, but I don't want to necessarily take directional risks on it, right? Because I don't have any clear, bias or outlook on the direction, but I do have a strong, maybe feeling or a strong uh, opinion that the implied volatility has moved away from where I expect it to be. Okay. So that's where the directional risk mitigation comes in. Right? Because I don't really want it. I don't want that risk. I want to hedge it away and not have to have that directional risk and implied volatility risk all on the same, in my portfolio. So let's say we look at this option here. I'm going to just click on it. All right. And when I click on the offer, it brings up this buy June 20th, 182.5 call for 49 cents. So this is just populating this for me, and I could change these parameters if I wanted to, but it just auto populates, this option from the side of, if I click on the offer, it does a buy. And let's say I want to do 10 of these instead of one. Let's do 10 of these. I'm going to run this analysis. So, this is how much it would cost. These are the theoretical values. And here I have this delta of 181. So what this is saying is the following. If I do 10 options, right, 10 options of buying the 10 of these calls, I have a delta of 180, a positive 181. And the Black-Scholes model is telling me the following, that if the stock goes up $1, my portfolio is expected to make $181, right? Because 18 cents, per option. I have 10 of them times 100, $181. If it goes down a dollar, I'm expected to lose $181. Right? So now I got this position that has a risk sensitivity to a dollar move. And then after it moves $1, I have new risk that I'll have to rehedge again. So the Black-Scholes model kind of says that for every dollar, you're going to have to look at your new position and see what your new delta is. So if I want to hedge that, maybe I don't want the $181. Maybe it's too much for me, right? I could hedge the whole thing, but how do I do that? Well, if I sell $181 worth, 181 shares, right? 181 shares. Well, if the stock goes up $1 and I'm short 181 shares, I'm going to lose $181, right? I have 181 shares that went up, but I'm short them. So they went up $1. I lost $181. But if my options are expected to make $181, well, I broke even between those two positions. On the other side, if the stock goes down $1, well, my options are expected to lose $181, so that's a loss. But I shorted 181 shares. So if I shorted them and I could buy them back cheaper $1, well, I made $181 there. So those two, the options and the stock position, offset. So in that case, and keep in mind, it's not always going to work exactly like that. These are estimates to get you close, right? So it's not like, but what you're doing is hedging off a lot, because some people are, well, is it exactly like, there's never like an exact like that. The markets don't move that way. Applied vols change, there's decay, but you're mitigating, right? So instead of, your position making or losing 180 or 200, you're mitigating your risk to a couple dollars, let's say. And this way, what you're doing is saying, well, I mitigated or hedged my directional risk, and now isolated more of the position to implied volatility. So now most of my portfolio is now exposed to the changes in implied volatility. So if the implied volatility of the option goes up, well, even if the option goes down, if the implied volatility goes up, well, I'm expected to make, because I didn't lose as much on the option. So imagine like this: if the stock goes down, if implied volatility stays the same, I'm expected to lose $181 on this position. But if implied volatility goes up, well, the options may not lose $181. Maybe they lose 90, right? Let's say they lose only $90. But my stock position will gain 181. So in that instance, the implied volatility worked in my favor, and my portfolio net gained. Okay. So this is quickly showing a position risk. Now, of course, we could get fancier. This is only, as traders, you're doing trades. You're looking for good options to buy, good options to sell, because it's not about one, you're not going to get this one perfect trade or one this amazing, oh my God, here I found this trade. It's so beautiful. I'm going to do this and that's it. I'm set for life. It's not like that. So you're always looking for different options. You're going to end up with these portfolios. So let's say we have these portfolios, and then with 10 options, this may be easy, but let's say you have, I sold 3 of these, over time, this is what your portfolio might look like. I sold 3 of these, then I found something here that looked really cheap. I got 1 of these in my portfolio, and then, these looked expensive, so I sold 2 of these. And now here's an option I'd like to buy. I bought, 4 of these. Well, you could see here, you're like, well, what the heck's going on here? What's my risk? I did all these trades that seemed good, but now I don't even know my risk. How do you manage this portfolio? Looking at it, how do you manage that? That would be, nobody could do all that in their head. So you need these tools to help you out. Well, what is my delta risk? What are my risks going up, down? Like, what are my risks here? Because I have to mitigate them, right? I could have tail risk here that I'm not aware of. I could have a lot of theta risk here, or where this portfolio is going to decay monstrously if I don't do something, or I have this delta risk. So you could see here that this is not an easy portfolio to manage by eyeballing it. So we need some tools here to help us out. I'm going to run that analysis. And here, let's just come down here. Now I see, okay, now it's much easier. I see my risk. I have about 199, let's say 200 deltas. So if the stock goes up, my portfolio, it looks like it'll gain $200. If it goes down, we'll lose $200. I have my gamma, vega. It's we're not doing that today, but we can. And my theta, how much this portfolio is going to decay. This is kind of what it looks like as the stock moves around. So this helps manage and mitigate an option portfolio, option risks, where now we could see where is our risk, how does this look, if the stock moves, how does this look, if implied volatility moves, because we got vega risk here, theta. And by doing this, this allows us a lot more freedom to trade and look for different opportunities. Now I might be looking for an opportunity to sell some delta or sell an option, buy a put, and so forth. So, Will, I'm going to stop right there. I think, we covered it pretty comprehensively today.
That was great. We had people really enjoyed today's show. We also had a lot of good comments about yesterday's SPX and VIX webinar.
Oh,
People watched in replay and are very happy that those new features are out there. And I know
thank you.
everyone worked really hard to get it out. It took a while, but it's been well worth it. Thanks for bringing them those to us, Dean. Thanks for today's show. Options Delta Explained. You have a great day, buddy.
All right. Thanks, everyone, for joining. Stay safe out there. We hope to see you tomorrow.
All right, D. We'll see everyone for tomorrow's show. Thanks for putting this on, D. Everyone, remember to follow us, like us on all the social platforms, thumbs up on YouTube if possible. Everyone, thanks for joining us, and we will see you tomorrow. Have a great day. Bye-bye.